Hello, everybody. I'm Hadi here from Smart FX, and this is my live webinar where I'll be introducing the Forex market, the Forex industry to you. You guys will have a lot of questions. Hopefully, you get enough knowledge out of this webinar so you can be more educated than you were before. Let's begin. You can follow us on our social handles. You can see over there, we are there on Facebook, we are there on Twitter, on Instagram, on LinkedIn, on YouTube. And as well, you can see my personal mobile number is there below. You can call me, contact me, WhatsApp me anytime. I will be available for you guys. So if you want to stay updated with the latest content and what we are, you want to stay posted with what we are posting, you can follow us on our social handles. What is Forex? As you can see over here, Forex is an international decentralized way of exchanging money. It's a market where currency gets exchanged on a daily basis. So whether you be anywhere around the world, when you are doing currency transactions, buying one currency, selling other currencies, exchanging currency, that is considered Forex transactions. They do it at a corporate level, whether it be on a personal level or it be on like a money exchange or a business level. That is considered the Forex market. On the old times, basically it was more of a physical process. Now people do it through online methods, through applications, through their gadgets, and various other methods. That is the Forex market. There's trillions of dollars being traded on a daily basis. As you can imagine, the world Forex market, all the currencies in the world, that's a massive volume. Foreign exchange market is often referred as Forex, FX, spot FX, or plainly spot. Let's go a little bit in the history and background and what used to happen before. Before, major corporations, institutions, corporations had the ability of doing massive transactions of foreign exchange, of currencies. Nowadays, even the average person can do it on a daily basis through application, through gadgets. So we are very lucky to be alive in this time where technology is guiding us, helping us. And it's mainly because of the internet, basically, that we can do it on a daily basis with better rates, live updates, staying updated always with just a click of a mouse or just swiping throughout mobile telephones. We can stay updated about the market, about the prices, what is going on in the world, because everything is extremely fast now. Before there were firms called, like, even they are there today, hedge funds, they basically trade. They trade currencies to make a living, to make a profit. Before, only major corporations would trade it. Forex currencies are very simple. They're based on supply and demand. So for example, if one currency has more demand than it is getting traded against, it'll go up in value. So for example, if we take Euro USD, if Euro has more demand than the dollar against the dollar, Euro will go up in value. Therefore, dollar will weaken against it. Vice versa, if dollar has more demand than Euro, dollar will go up and Euro will go down. And this will further affect the whole world market. Whether you are trading other currencies, because if you think about it, world reserve currency is dollar. Everything is traded against the dollar in the world, whether it be commodities, forex currencies, everything is traded against the dollar mainly. When some currency is getting traded against the dollar, that is considered a major. A major because it has the most liquidity and the highest volume. So it's very simple. Whether it be euro, dollar, USD JPY, any currency, it's as simple as supply and demand. When a currency has demand, it goes up in value against other currencies. When it has less demand, it goes down versus like other currencies. Every currency is interchangeable with any other currency in the world. But dollar is basically the reserve currency of the world, where every currency is traded against the dollar. It's a simple way of understanding what the Forex market is. Let's talk about the gold standard system. It was implemented in 1876. Before the gold standard was created, all of the world would accept gold and silver and various other commodities as currencies. Gold, silver were the currencies basically around the world before. They used to exchange gold for buying assets, funding economies, funding wars. Basically, currency was a commodity before, gold and silver. What happened after 1876? Gold standard system came across, and countries started using paper as the currency around the world. What they used to do is they would keep a certain amount of gold or a maximum amount of gold. They will put a price to it and create equal amount of cash against it. So they can exchange currency, paper, instead of gold, metal, or silver. It adds more flexibility to the economy because imagine if you have to give a kg of gold to get something, that is a different headache. But if you have to just give a piece of paper and get other pieces of paper back, how easy does this transaction happen and occur? It simplifies the way of living. This is an example. Before World War One, gold was $20 an ounce. What happened eventually is that before, Britain used to be the world superpower. So they stopped using the gold standard in 1931. They started going towards the fiat currency. Now, what is a fiat currency, if you may ask? So remember, before currency used to be based around gold, and it was supposed to be called the gold standard. So the whole world was having gold backing up their currency. You can actually literally, that time you could go to the central bank or any bank near you, give an X amount of dollars and get an X amount of gold. It was that massive. Everyone was doing it. Afterwards, what happened was one of the biggest countries in the world, or one of the biggest empires in the history of the world, Britain, they stopped using the gold standard. They were shifted towards something called fiat currency. Fiat currency is basically a bond issued by the government, and it does not have any intrinsic value to it, but the government is basically promising that this note is worth X amount. So when they say it's $100, it doesn't have gold backing it. The government is backing it, and the government is providing value to it. So $100 is $100 today. Why? The government says it so. Before the end of World War II, around 44 nations, they thought that there's a need to set up a new financial system around the world. Things were getting too outdated for them. And obviously, World War II, things were in turmoil. There was mass confusion. So they held a conference in Bretton Woods, New Hampshire, to converse and see what they can do differently. So there was it's called Bretton Woods System of International Monetary Management. That was the name of the conference, which was held in 1944 with 44 countries. They sent delegates across the world from, there was a meeting, they continued. And what came was a method of fixed exchange rates. The dollar replaced gold standard to become a primary reserve currency. And at that time, this was one of the biggest things which happened in the financial sector. They created two international agencies to oversee economic activity: the IMF, International Monetary Fund, and the International Bank for Reconstruction and Development. The IMF, till date, these both banks, they work as balancing forces in the world. Wherever there's any turmoil or any problems, what happens is they step in and support the economy. For example, if you must have heard, recently Pakistan was going and still going through a lot of problems, economic problems. So what they do is they lend out money, low interests. They have special deals for special countries to support them survive massive times of confusion and turmoil and problems. So these are their main purposes why they were built. And they have been quite supportive to the world economy ever since. This is basically market timings. As you can see, the Forex market around the world work 24/7. But these are just trading sessions. First session which opens up is Sydney, 10 p.m. GMT till 7 a.m. GMT. Second is Tokyo, 11 p.m. till 8 a.m. GMT. Keep in mind, when these sessions are opening up, when these continents are getting into trading, it moves from Australia and it goes downwards till New York, America. So when Sydney opens up, there's a massive influx of volume in the market. People start trading, people get involved in the market, flow starts, the Australian currency is fluctuating, even the stock market, Australian stock market opens up around that time. Now what happens is, when it goes to Asia, Tokyo, now more parts of the world are getting in the market. Traders are going in, Tokyo, Japanese traders are going in, Asian market is waking up, they are creating a bigger influx in the market, and you will see currencies like Japanese yen will have volatility. They will start increasing in volatility. They will start going up and down because a massive influx has just hit the market. Fresh traders have gotten in. Then London opens up. Now it is becoming bigger and bigger. Out of all the names I've just taken, Sydney, Tokyo, London is the biggest in terms of volume. What happens then? London traders wake up, their hedge fund people wake up, they start trading, corporations are woken up, they're getting into the market, and it begins a massive volume, round three, basically. Consider it like rounds. And at the end, the biggest volume in the world for trading is by America. When America opens up, there is a massive influx of traders, massive influx of volume, trillions of transactions, billions of dollars worth of transactions, start going into the market. There are buyers, there are sellers. Imagine a great big tug of war going on. One side is pulling, the other side is pulling. Who will win? We don't know. But what happens is, this creates movement and volatility in the market. At this time, traders are making profits, cutting losses, getting into the market, just they're sharp as ever, watching the news, taking it step by step, in on the game. And these are just timings from October till April. As you can see, Sydney 9 p.m. till 6 a.m., Tokyo 11 p.m. till 8 a.m., London 8 a.m. till 5 p.m., New York 1 p.m. to 10 p.m. The times adjust according to the weather and the climate, basically. So in winter, it gets different. In summer, it gets different. So that's why there's a difference of timing. 1 hour difference is not a big deal. This is an explanation of base and quote currency. As you can read over here in Forex, the base currency represents how much of the quote currency is needed for you to get 1 unit of the base currency. As you can see the example below, it is showing Euro USD, Euro versus USD. So it takes $1.0676 to buy a single euro. It means euro is stronger than dollar in this scenario. It can go lower. Dollar can become stronger than euro, but in this scenario, it is not, clearly. If you go lower, you see 100 euros buys $106.76. Clearly, euro is stronger. So this is basically magnified to a bigger scale. Imagine now, instead of just buying 100 euro or 1,000 euro, you buy hundreds of thousands of euros. And the price is moving, it's fluctuating. It'll affect your investment. That's where traders come and they try to benefit the market. They try to make a profit from the market. They do it on a much larger scale, using the tools, obviously, which brokers provide them. This is something very interesting. Leverage. What is leverage? The exact definition, you can read it out over here. In finance, leverage refers to borrowing money to supplement existing funds for investments. Imagine, I'll give you an example, a very small example. When a person goes to even buy a house, he puts down a 20% mortgage, gets the house, a 20% down payment, gets the house. Now he's in control of the house. He owns 100% of the house, but he only put down 20% of it. What did he do? He leveraged his funds to buy the complete asset. The same thing goes in trading. The brokers allow you to leverage your funds and go into trading. If, for example, you have a $10,000 account, there are brokers which provide 100x leverage. It means you can trade up to 100x of the actual amount you invested. Remember the previous example I gave you about the 100 euros and into hundreds of thousands of dollars? Now imagine if on a daily basis, you're trading with massive flows of currency on a medium level. I would not suggest that you go high, extremely high. Let's say you have a $10,000 investment and you have $50,000 worth of trade going on. Let's say you buy $50,000 worth of euros and the market price goes up for euros. You will be benefiting on the 50,000, not on the 10,000. So that helps you magnify your profits. But there's another side to it. If the market goes against you, their losses occur. But it is not something that your person just goes like, oh my God, I've lost all my money. No, they are manageable losses. And using the tools which the brokers provide, you can set stop losses, limits. We'll get into that in the next webinar. This is just a brief. So leverage is utilizing basically other people's money to make money for yourself. And that's what we assist you with. This is an example which I talked about. See, $250 deposit, and if the leverage is 400, means you can 400 times the amount of money you invested inside. So 250 times 400 equals $100,000. With the $250, you've actually bought $100,000 worth of currency. It sounds amazing, but it is highly risky. You should keep that in mind. It's not something we would recommend, but it is what is accessible to you. You can utilize this for your own benefit. What is margin? It's very simple. It correlates with leverage. When I said that you can buy $100,000 worth of currency with just $250 worth of capital, the $250 is the margin requirement. Margin means the money required to open the trade. So if you have $100,000 and someone is giving you 400x leverage, you just divide the value by the leverage and you get $250. So imagine if we change the equation, if you have 100x leverage and you're buying $100,000 worth of currency, then it means 1%. $1,000 will be your margin requirement. Margin means the money required to open the trade, which you need to have in your account to open the trade. It's as simple as that. And this is second name of trading. It's called margin trading, not just trading. That's the proper way to pronounce it. Margin trading. What is a pip? Pip stands for point in percentage. You can literally imagine it. 1% and 100th of that, 0.01. The point in percentage. It is the smallest fractional move in currencies. I'll show you over here. As you can see, there's an example over here of JPY and HUF. By the way, any currency, let's take Euro USD, it has 4 decimals after the point. The 4th decimal is considered a pip. If it is not something like Euro USD, it's like, let's say, Japanese yen or HUF, the 2nd decimal after the point is considered a pip. So it's a way of calculating profit and loss, calculating how much the market moved. But keep this in mind, the 4th decimal after the point. There is even a 5th decimal, but that is called fractional pip, a pipette. It's more into details. It's more advanced. So let's stick to the pip. Bid price. Bid represents the price at which a trader can sell the base currency. Remember we spoke about base? Base is on the left side, quote is on the right side. So a bid represents the price at which a trader can sell the base currency. An example is shown below. In USD JPY, the price is 1113.67 and 1113.69. The base currency is USD because it's on the left side. So it will take 113.69 yen, so I'm sorry, 67 yen to buy $1. You got it? And if you go lower, this is about the ask price. Ask represents the price at which trader can buy the base currency. Shown to the left. Always remember that, the left one. And the example below is USD CHF, 0.997 and 0.999. The base currency is USD and ask price is 0.9999, meaning you can buy $1 for 0.9999 Swiss francs. What is a lot? A lot is a standardized system of measuring the volume of your trade. So let's go in currencies. If someone says, I have bought one lot of currency, it equals to 100,000 units in the base currency. So let's say Euro USD, it means he has bought 100,000 euros. If you go with, let's say, USD JPY, it means he has bought $100,000. Whatever the base currency, 100,000 units in that. That is a lot in currencies. If you go towards commodities, things change. Keep in mind, currencies, 100,000 units, is numerical. But when you go to commodities, it's actually by volume or weight. So let's give an example of gold. You need 100 ounces, which equals to one lot in gold. So when you buy a lot in gold, it is 100 ounces, equal to 100 ounces. Now keep in mind, the price can fluctuate forever. Gold prices can fluctuate up and down anywhere, but the weight remains the same. 100 ounces remain 100 ounces. So it's a simpler way of defining, basically. Over here, you can see there's a standard lot size, which is 100,000, mini lot size, which is 10,000, and a micro lot size, which is 1,000. And it is showing you on per pip how much you gain or lose. So if you have a lot, your account is going to be affected at $10. So if a pip moves up, you make $10. If it goes down, you lose $10. If you have a mini lot, it's $1 per pip. And if you have a micro lot, it's 0.1 per pip. Keep in mind, market moves a couple of hundred pips a day. Not necessarily, sometimes there's low volatility, but you can expect from 100 to 300 pips every day in commodities. It's normal. And nowadays the volatility has been high, especially when some news comes out or something like an event takes place, the whole market in general becomes highly active, especially things traded against the dollar. It was my pleasure hosting this webinar for you guys. Please stay updated, follow us on our socials, and we'll be back. Hadi Shafiq from SmartFX, signing off.